Leverage to yield. Wealth creation through syndication. My name is Jeffrey Smith. Objectives. Prerequisite. Please view Calculating Capitalization Rate video before viewing this video. You will learn leverage to yield. I'll include a quick review of income valuation. I'll show how to calculate the leverage to yield. I'll show negative leverage and positive leverage. Leverage to yield. When buying income property with leverage, debt, be sure that you are leveraging the return on equity with a higher yield than the cap rate. Leverage to yield, LTY, is the return on equity, ROE, divided by the capitalization rate, cap. The LTY is the multiplier on the cap rate to achieve the return on equity. Sophisticated investors apply LTY greater than 1.0. Income valuation. Net operating income, NOI. Maximum allowable offer, also called the bid, MAO equals NOI divided by cap rate. Conversely, capitalization rate, cap equals NOI divided by MAO. Loan to value ratio, LTV, equals the debt present value divided by the maximum allowable offer. Conversely, the debt present value, DPV, equals the loan to value ratio times the maximum allowable offer. Equity to value ratio, ETV, is the complement of the loan to value ratio, 1 minus LTV. Leverage to debt, LTD, equals loan to value divided by equity to value, LTV divided by ETV. Leverage to debt represents the amount of debt you are receiving for each dollar of equity. Debt coverage ratio, DCR, equals net operating income divided by annual debt service. Debt coverage margin, DCM, is the reciprocal of debt coverage ratio. DCM equals 1 divided by DCR. Cash flow margin, CFM, is the complement of debt coverage margin, 1 minus DCM. Annual debt constant, ADC, equals annual debt service divided by debt present value. Annual debt service, ADS, equals annual debt constant times debt present value. It's also equal to debt coverage margin times net operating income. Capitalization rate, CAP, equals debt coverage ratio times annual debt constant times loan to value ratio. This is the alternate calculation when there is debt on the property. When there is no debt on the property, then equation 3 applies. Return on equity. This is also called the cash-on-cash return. ROE equals the quantity DCR minus 1 times annual debt constant times leverage to debt. The net cash flow before tax, NCF, equals net operating income minus annual debt service. It's also equal to cash flow margin times net operating income. The equity is equal to the maximum allowable offer minus the debt present value. It's also equal to the equity to value times maximum allowable offer. The return on equity, again, is ROE equals net cash flow divided by equity. Leverage to yield, LTY, equals the return on equity divided by the capitalization rate. It's also equal to the cash flow margin divided by the equity to value. Calculating leverage to yield. Return on equity equals net cash flow over equity. It's also equal to cash flow margin times net operating income over equity to value times the maximum allowable offer. You'll see here that NOI over MAO is equal to the cap rate, and therefore we can divide by the cap rate, and therefore the return on equity divided by the cap rate equals the cash flow margin divided by equity to value. Neutral leverage. Leverage to yield is equal to 1.0. That means the return on equity, ROE, is equal to the capitalization rate, CAP. The cash flow margin, CFM, is equal to the equity to value ratio. Cash flow margin, CFM, equals 20%. Debt coverage margin is the complement of cash flow margin, is 80%. Debt coverage ratio is the reciprocal of debt coverage margin, 1.250. This is a very typical debt coverage ratio for commercial properties. Equity to value ratio, ETV, equals 20%. Loan to value ratio, the complement of equity to value ratio, is 80%. 80% debt, 20% equity. Leverage to debt, LTD, is 4.0. It's equal to the LTV divided by ETV. 80% divided by 20% is 4. Leverage to yield, LTY, equals 1.0. This is equal to the cash flow margin divided by the equity to value. Cash flow margin, 20%, divided by equity to value ratio, 20%, equals 1. Let's pick an annual debt constant, ADC, equals 7%. We calculate the return on equity, ROE, to be 7%. It's equal to the quantity DCR minus 1 times the annual debt constant times the leverage to debt. So DCR minus 1 is 0.25. The leverage to debt is 4. 0.25 times 4 is 1, leaving just the annual debt constant. The capitalization rate, CAP, is also 7%. It's equal to debt coverage ratio times annual debt constant times loan to value ratio. The DCR is 1.25. The loan to value is 80%. 1.25 times 80% is 1, and that leaves just the annual debt constant. That's why the leverage to yield is 1.0. There is no leverage on the capitalization rate of the property. You'd be better off to take your equity investment and buy a smaller property for all cash and not have the risk of debt on the property, because your yield would be the same. Negative leverage. This is even worse than neutral leverage. Leverage to yield is less than 1.0. The return on equity, ROE, is less than the capitalization rate, CAP. The cash flow margin, CFM, is less than the equity to value ratio, ETV. Let's pick a cash flow margin, CFM, 15%. The debt coverage margin, DCM, is the complement of the cash flow margin. It's 85%. Debt coverage ratio, DCR, is the reciprocal of debt coverage margin, 1.176. Equity to value ratio, it's the same as the previous example, 20%. Loan to value ratio, 80%. Leverage to debt, LTD, equals 4. 80% divided by 20% is 4. The leverage to yield is now 0.750. It's the cash flow margin of 15% divided by the equity to value ratio of 20%. Annual debt constant, we pick 7% again. Return on equity is now 4.941%. And the capitalization rate is now 6.588%. You can see that the return on equity is less than the capitalization rate. This is even worse than the neutral leverage. And it's caused by a decrease in the debt coverage ratio. That implies a decrease in the cash flow margin. Positive leverage. Leverage to yield is greater than 1.0. The return on equity, ROE, is greater than the capitalization rate, CAP. The cash flow margin, CFM, is greater than the equity to value ratio. Cash flow margin, 20%. Debt coverage margin, 80%. Debt coverage ratio, 1.25. We reduce the equity to value ratio to 10%, which increases the loan to value ratio to 90%. Leverage to debt, LTD, is now 9.0, LTV divided by ETV. 90% divided by 10% is 9. Now the leverage to yield, LTY, is 2.0. That's the cash flow margin divided by the equity to value ratio. 20% divided by 10% is 2. Again, the annual debt constant, ADC, is 7%. We calculate the return on equity as 15.750%, and the capitalization rate is 7.875%. The return on equity is twice as large as the cap rate. This is how sophisticated investors invest in income property. This is how they use leverage. They make sure that their return on equity has a positive multiplier compared to the capitalization rate. Introduction to Income Valuation and Syndication. Learn how to calculate the income valuation of an income property. Learn how to calculate the yields for multiple tranches, structured financing. Learn how to get paid to buy income property with other people's money, OPM. Learn how to get paid when you buy with other people's money, get paid a percentage of cash flow, and get paid a percentage of the exit strategy. Go to this link, http://bit.ly/itivas-1. Introduction to Income Valuation Syndication. This has been Leverage to Yield. My name is Jeffrey Smith, and thank you for your support.